What's the Risk? Hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the CRSP 1 to 10 deciles, or CRSP US Total Market Index, which represents 100% of the investable US equity market, covers around about 3,500 stocks, and is the basis for Vanguard's VTS or VTI, depending on if you're in Australia or the US. Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make us tap to sign. These are simple concepts. We'd like investors to better understand risk so they can make informed decisions. Periodic performance. Just a little bit of background. CRSP stands for the Center for Research in Security Prices, and it's affiliated with the University of Chicago, and it's got a long history in compiling and researching data. I've added here the S&P 500 because a common comparison will be the S&P 500 versus the US total market, because investors will often find themselves wondering which one they should invest in. Returns are going to be similar, but as you'll see, they're not going to be the same because there are about 3,000 more companies in a total market index. And in recent years, as large cap stocks have dominated, you can see the divergence there, especially in the 3-year period.
Yeah, it's really important to recognize that the whole of market, the CRSP index, is far more representative of what's available to all investors that want to buy US stocks. Obviously, the S&P 500 targets only the 500 largest companies, and that's still a very worthy index to track. And then probably even more prominently and certainly reported more in the traditional media is the Dow Jones. The Dow Jones Industrial Index has only 30 stocks in it. Now, if we put the Dow onto this same page, you would see very similar outcomes there as well, because they're such, dominant players in terms of size and weightings into the respective indices. But it's certainly the case that if you want to understand what returns have been available to US investors going right back to 1926, the CRSP index is definitely the best indicator, the broadest indicator of what's been available to investors in that market.
And just to highlight the annual returns in that 3-year period where there was that difference, go back one extra year, the total market outperformed in 2020. So some years it's going to be better, other years it's going to be worse.
I think the key message for investors with this particular slide is to just understand that it is absolutely possible the CRSP index, with its exposure to 3,000 more stocks, which by definition will be smaller than the 500 in the S&P, is going to give rise to a size effect. Now, we know that over long periods of time the size effect actually works, but over short periods it can be very detrimental to a portfolio, and we can see that quite clearly in 2022 and 2021 when large cap stocks were shooting the lights out. But in 2020, when large cap stocks weren't the flavor of the day and small caps were really being sought after by investors, all of those negative results from 21 and 22 are all but recovered by way of the extra gains that were available in 2020. So it's just simply a size effect, and accept the fact that it does happen, it will happen again.
And annual since 1926, just to underline how differently the US total market and the S&P 500 can perform. They don't necessarily move in lockstep, except there's one year there, 1985, when they rounded out exactly the same, but overall the correlation is high, or very high.
In 1985, the 500 biggest stocks delivered the same result as 3,500 biggest stocks. Well, that's just random chance, and it's just noise. If you look at the notation in the bottom right-hand corner, correlation 0.991. My original scholastic endeavors were in mathematics. A correlation of 0.991 is so statistically significant that you could all but claim that these are the same things. I would just say to people, accept that whether you target the S&P 500 or whether you target the CRSP Total Market Index, you're doing almost the same thing.
And growth of wealth. I've just done this since 2000, just to highlight over this period, and the total market has been the winner.
The difference between $5.30 and $5.11 over such a long period of time is just random chance and noise, because if you look at different points along the way, the S&P has been the winner, then CRSP has been the winner. It's pretty much just noise.
And range of returns, as you'd expect here, a lot of it's dominated by the Great Depression period, and every one of these start periods for best and worst are exactly the same as the S&P 500, except the 5-year negative.
It's important to recognise that the data series for the CRSP index goes back to 1926. Barely after it started, that data series has to deal with the Great Depression, where the stock markets around the world absolutely collapsed. If you look at the 1-year result, the worst 1-year result at minus 65%. In effect, investors losing 2/3 of their investment value. In terms of 3-year numbers, the rout effectively started in the July of 1929. If you want to look for the worst 5 years, then of course you go back to the previous peak, which was June of 2027. Every one of those awful results, whilst 100% realistic and actually occurred, they all stem from the one event, which was the Great Depression.
And rolling in your returns, I suppose this offers a fuller picture of how things go for a total market return over nearly 100 years. There's always going to be some downturns there. As you can see, they pop up quite regularly, but it's just a matter of staying invested through them because there's a lot of good performance above the line.
When you consider that there's 97 years worth of information here, which is at least double the life, pretty much double the life cycle of any adult investor. It doesn't matter which 50 years you pick out of the 97. The yellow bars above the line dwarf the yellow bars below the line. What that means is patient investors get well rewarded. Impatient investors, as usual, are the ones that suffer.
Historic chance of positive and negative, and this is pretty similar to what you'd see in many other developed markets, and probably pretty similar to what you'd see in the S&P 500 as well.
When you look at the way markets, share markets in particular, can be volatile, if we focus firstly on individual monthly results, it's almost exactly what we've spoken about in the past. 2 months out of 3 go up, 1 month out of 3 goes down. Then you look at, say, 5-year periods, and you've got 1 in 10 chance of going backwards. And when you go to a 10-year period, it's a 1 in 20 chance. Now, this, of course, includes all of the Great Depression. So it stands to reason that there's got to be some negative data in there. And obviously there is.
Largest fall in time and recovery. And I've done this post 1945 because we know what the 1929 one looks like. This is in the global financial crisis, lose a bit over half. And it's about 4.5 years back to where you were.
Most of the people that will, listen to this video and watch, this period of time is going to be part of their lives. And we all actually experience that. The average Australian portfolio, particularly in the superannuation arena, holds about 70% of its assets in stocks, both locally and globally. The average portfolio went down in value around about 35%. And that's just simply 70% of your portfolio times minus 50. If investors were just to look at the 3 years before 2007, they would see a very different chart with a major increase in value leading up to the start of the GFC, where these falls were seen.
Yeah, risk return or the efficient frontier, slightly less volatile than the S&P 500 and slightly lower return.
And that's exactly what should happen, Daniel. The traditional portfolio theory will tell you that, as Bill Sharp said in his dissertation that won him the Nobel Prize, to expect a higher rate of return, you have to expect higher volatility. And that's exactly what we're seeing on the screen.
And it's also the descriptions of data. Thanks for your time.
Okay, thanks everyone.